start with this savings investment identity, and there's a couple different ways you can kind of derive this and use some algebra here. But basically, the idea is just saying that investment at some point has to be financed by savings. So now remember, here we're talking about capital investment, building a factory, machinery, that sort of thing. And so someone needs to postpone consumption in order for this to happen. Someone needs to supply some savings that gets channeled into investment, and that brings in financial markets. But that's basically the idea that we want here. So at some point, if there's going to be investment, there's got to be some savings. Someone's got to finance that investment. So that's all we really need this for. And for a closed economy, then you have just domestic savings, whatever savings you have for the entire economy, that's able to finance some level of investment for your economy. Now, once you open it up to the rest of the world, then you could have foreign savings as well as your domestic national savings in order to finance investments. You could have foreigners supplying some savings in order to finance some of your domestic investment, and obviously they're going to get a return for doing that, whether it's lending money or buying stock or something like along those lines. Okay, so let's think of an example. I'm going to have the U.S. Trading with Germany here. Now, for now, we're not going to worry about the currency exchange. We're going to come back to that in a second, but we just want to think about what's happening when there's trade between two countries. So let's say that the US is going to be running a trade deficit with Germany. We're going to be importing some goods from Germany, some net imports. So maybe we're exporting as well, but we're importing more than we're exporting. And so we're just looking at the net change of someone in the US. Might think of it as an individual. Maybe it's easier to think about that way. But someone in the US is paying some money to Germany in order to buy some goods. Now, ultimately, this company in Germany or this person in Germany probably wants some euros in order to spend or pay their workers or whatever. So, at some point those dollars might be converted to euros before it gets there, or Germany takes dollars, converts it to euros. That's not going to matter for our purposes right now. But we just know that some money is flowing to Germany in order to buy some goods. Germany, in turn, sending some goods to the US, right? So this is going to be a trade deficit. From the US perspective, it's a trade surplus from Germany's perspective. Now, the key thing here is that the flip side of this trade balance is what happens to this money that Germany is now earning from the US. So they're earning dollars. And again, it doesn't matter if they convert those dollars to euros, because that means someone else is holding dollars. So someone's holding dollars as a result of this transaction. Well, what can you do with dollars? Only thing dollars are good for is to buy things that are priced in dollars. So that means either dollar goods or dollar asset. So if Germany just turned around and bought US goods, we would no longer have a trade deficit for the US, and we would just have balanced trade. But we're assuming in our example that we don't have balanced trade. So if Germany doesn't want to turn around and just buy goods, well, then that means they're going to want to buy US assets, right? They want to earn a return with their money if they're not going to buy goods. So it's not like anyone's forcing them to do anything here. But so they're going to turn around and buy US assets. So that's kind of the flip side of this transaction, which is very important to think about. So they might turn around and lend that money to the US, buy some US government bonds. They might buy some US stocks, some corporate bonds, some kind of US assets. So that's money now flowing from Germany to the US, and in exchange the US is selling some kind of asset, right? Stock, bond, something like that. So my slide jumped ahead here, but so this top part of this picture is the trade balance, like I mentioned. I'll mention the current account in a minute, but the trade balance is going to be the main component of this larger account called the current account. So we're just thinking about the trade balance here. So this trade balance has to be offset by what's going on down here, which is this purchase and sale of assets. And so that we call the financial account. So we have the current account, which here it's going to be driven mainly by the trade balance. So often you'll see these more or less used interchangeably, but as we'll see in a second, the current account includes a couple more items. But so the financial account is the purchase and sale of assets. Also including direct investment. So if that means something like Germany investing directly or building directly a U.S. Factory in the U.S. So there's lots of foreign-owned plants in the U.S., for example, that would be considered foreign direct investment. So that's also included in the financial account. So this money has to flow somehow, in a sense, back to the U.S. In terms of purchasing those assets. So it's very important if you want to see the whole picture of an international transaction, these international balances, is to think about the flip side of this transaction. So we have the current account and we have the financial account. So in this case, in this example, the U.S. is running a current account deficit, again, assuming that the trade balance is kind of the main driver here, which is normally the case. So current account deficit, which means the financial account from the U.S. perspective has to be in surplus. In other words, money is flowing into the U.S. In a financial account. This money is flowing out in the current account, but it's flowing in with a financial account. And so you can see that the savings investment relationship is just the flip side of the trading relationship. So the fact that German money is flowing into the U.S. buying U.S. assets, essentially foreign savings are being supplied in order to finance some kind of U.S. investment. So another way of saying that the U.S. is running a trade deficit or a current account deficit is that domestic savings are less than investment and foreign savings are being used to finance investment. So by the U.S. running a deficit in the current account, another way of saying that is that Germany is investing in the U.S. It's helping to finance U.S. investment. And so it would be misleading to say that it's necessarily a bad thing to be running a deficit here, because you could just as easily say Germany is helping to finance U.S. investment, or it could be financing U.S. government, if they buy up U.S. government bonds, could be financing government spending, whatever the government's borrowing that money for, and then you could, argue whether that's leading to any kind of good spending or not, but that's another issue. So in this case, deficit over here is offset by the surplus over here. Germany would just be the opposite, right? Running a current account surplus, exporting more than they're importing, again assuming trade balance is dominating the current account, which means they are running a financial account deficit, which means money is flowing out of Germany in order to buy those assets.